Tyler is in charge. He's, I guess, a director of trading and execution for Blackpier Capital in Knoxville, Tennessee, but I guess it's a distributed company because he lives in California, and I believe some of the other officers are residing in other places. But he's their lead trader, as I understand it, and so that really puts him closely in touch, I believe, with the kind of interest we have here, because we're our own lead traders for our own accounts. And he also, another reason that it's just extremely attractive to have him talk is that his company, Blackpier Capital, is trading John Locke style, butterfly style trades using several different varieties of trades and their own adaptations. They're certainly not literally John Locke's or anyone else's trades, but they're trading some of the very same trades as we are in our own individual accounts, and therefore his perspective should be very, very close to ours. And he what could you tell us basically a little bit more about Blackpier Capital before we get into the talk?
Of course. So Blackpier Capital is a private partnership where we're investing our capital right alongside of all of our clients. So our strategies or our capital, our money is in the same strategies as all of our clients. And our clients use us for a variety of reasons. We have some people that are close to retirement or retirement age that use us for a overall portfolio hedge. So, they have their long stock portfolio, and they'll invest a small amount in us to offset their returns in volatile times. We also have some younger people that use us for growth. And then we even have some traders who utilize us for some diversification from their own trading strategies.
Really, you're aiming to smooth out some of those valleys and hills by diversifying several different strategies, as I understand it.
Exactly.
Now, your service is only directed to qualified investors. Is that correct?
Correct.
So most of the people here really would not be able to take. I shouldn't make any assumptions, but some of the people here, are not going to qualify as active investors, including me. I'm sorry, as eligible investors for because you have to have also.
Yeah, we're always trying to people out in any way that we possibly can. Whether it's through them actually investing with us or doing presentations like this. We do some of these presentations when we've done a few of them in the past, and we're always trying to help people out in any way possible.
I think one of the areas that is of most difficulty for people is volatility and skew, and trading skew. And Tyler's going to give a very good perspective on that. And after that, we're going to have interaction with him. I have endless questions I alone could ask him, and I'm sure many of you do also. So let's have a nice warm hand for Tyler to welcome him.
Sure. Yeah. Thank you. Yeah. Thanks again for having me here. I've been very excited for a long time to be able to give a presentation on this and give a talk. This is an area that I've been really interested in for a while, and I think there's great potential for application to trading. Now, we're going to cover quite a good bit of information today, and I hope that no matter where you are at in your trading, whether you're a beginner trader or an advanced trader, that you'll be able to get something from this presentation today. Now, it is going to be a good bit of info, and we'll get into the weeds a little bit with it. But I want this to be a resource for people to come back and refer to, and to be able to come back so that they can improve their trading. So first, before we get started, let's see if I can click forward. There we go. So quick disclaimer before we get started. I'm not an advisor. Blackpier Capital is not a broker-dealer. Any examples and trades that you see in this are all hypothetical, and options involve a high degree of risk. And this presentation is for educational purposes only. All right. So this presentation is looking to answer 4 main questions. 1, why should all traders care about skew and volatility? Now, it's not just options traders that I think can benefit from knowing what this is and how to use it, but even traders who are trading, macro stocks, maybe even Forex. There's value to be gained from just knowing how the skew moves and how it behaves. Second, I want to identify and measure different skew environments. So there's a bunch of different ways to measure skew, different ways to look at it that we'll get into. And I want to talk about, what's the best way for us as certain options traders trading certain strategies to look at it. And third, I want to look at how does changes in skew affect our butterfly trading returns. So there's a lot of people out there who are trading some popular publicly available strategies, mostly centered around some type of butterfly, whether it's hedged to the upside, broken wing, just some variation of that. And so for the majority of this talk, really all of it, I'm going to be focused on the Russell Index options. Now, a lot of this can be applied to S&P, some different indices, even stocks. So the knowledge will expand, but for all the examples in this presentation, I'm going to be focusing on Russell Index options. And then lastly, number 4, how can we design a trade to take advantage of different skew environments? One of my favorite humans in this world, he has something he likes to say is, if more information were the answer, we'd all be billionaires with abs. But unfortunately, more information isn't the answer. Is how do we actually apply this knowledge? How do we take what we've learned and make something from it? And so that's what I hope to do, is cover these ideas. So let's go ahead and jump into our first example. So let's look into what is volatility. We'll start there. So here I have 2 different put options. On the top put, bottom put, same trade. But what's the difference between these two? The top one is costing us $3,000 to buy it, and the bottom one is costing us $4,500 to buy it. And these have the same probability of having value at their expiration. So what's affecting this price? That's volatility. And so one idea that has really helped me understand what volatility is equating volatility to demand. So thinking of higher volatility being a higher demand. So if we put that idea back to this put right here, where the top one's costing us $3,000, the bottom one's costing us $4,500. Where's the higher demand? Well, higher price, probability held constant. The higher price is the bottom, so there's higher volatility there. So, but volatility doesn't necessarily give us the price. It's demand plus probability is what's going to give us the price. And these are 2 concepts that are going to come up throughout this presentation of both demand and probability. We'll get into some definitions and look at more examples throughout this, but for now, demand plus probability gives us our price. And so from here, thinking of volatility being demand, we can start to answer, what is skew? Skew is the demand for an entire options expiration. So each individual option plotted on a curve representing just its volatility or demand. All right. So let's draw out our first skew. Let's show what this looks at. So right here, we'll say this is at the money. So where the market's at right now. And we'll call this, let's call it 500. Then up here, we'll say 600. And down here, we'll say 400. And then, so we have market price down here. And then on the y-axis, we have volatility, or our demand. And then, we'll say volatility here is 10. And then up here, let's call it 30. All right, so the skew curve is divided up into 2 sections. Really, it's looking at out of the money puts and out of the money calls. And on this side, on the left side, we're going to have our puts over here. And then we're going to have our out of the money calls over here. And so kind of like we saw in that last example, let's plot that out. So we had our at the money put, call it, it was a volatility of 10. So here's our at the money volatility. This is generally what most people are referring to. What they ask, what's volatility doing today? What did the VIX do today? And the VIX is a little bit of different measure, but it's essentially trying to capture, this at the money volatility. What did it generally do today? And so let's think about it before we start plotting out more points on this curve. As we move back into the put side, back over here, what do people with long portfolios have? And this is one possible explanation for it. But what do people with long only portfolios want? They want portfolio protection. And if you buy a put and the market goes down, you make some money. So there's going to be, as you go further and further back behind the market, you're going to have an increase in your demand for these puts. And then on the call side, let's think about, what are investors doing on call sides? Most people have long-only portfolios, so they don't necessarily want upside exposure. Now, this can change as market environments change, but speaking generally here, they're not buying calls to add more long protection. And once again, this is just one explanation for why the curve might be shaped this way. So there's not quite as much demand right here, and even in front of the market with these out of the money calls. Also, you think of what's happening here, I've covered call selling, pushing the demand down for these. So the bottom of the curve isn't necessarily at the money. It's a little bit over here on the call side. And then as we move further out, there starts to become a little bit of an increase in calls because, investors, they're buying lottery tickets out here, or at least one possible reason for it being a pump up. We connect our dots, and here we go. This is our skew curve. This is what an option skew looks like generally for, the Russell 2000, S&P 500. Most indices have what's look like a skew because investors will prefer to buy deep out of the money puts to protect their portfolios, pumping up the demand for this. Now, I said that there's one other piece to this, and it's probability. Because when you take skew or demand plus probability, that ultimately gives us our price. So what does that look like on this? Because let's consider this back point right here. You have a high volatility back here, but if we think to an options curve or an options chain, way down on that chain, if you scroll down, these things are only trading for, 5-10 cents. There's not much. But I'm sitting here saying that, there's high demand for these. What's happening? If there's high demand, shouldn't the price be higher? Well, and the reason for it not being that low is because of probabilities. So most of us have seen a regular probability distribution curve before, that bell curve shape that looks something like this. Now the at the money is about right there in the middle. So let's continue focusing on this put right back here. Because there's such little probability that the market's actually going to come back here, the price for this option is going to be lower, although the demand for it's higher. So in a relative sense, because the demand is higher for this, you're going to have to pay more and more the further you go back for your put protection. And then so, as we get closer and closer to the market, because the probability that at expiration, your option is going to have some sort of value, you're going to have an increase in the actual price of your option. So these are the two central ideas that, like I said, I'm going to continue referring back to and looking at is how does skew and probability move, what's affecting our price? Because the one reason I'm not isolating skew and just looking at that is because we want to see how these changes are affecting the price, because that's ultimately what determines our profit and loss in our positions. And so that's why when you talk about skew, you also have to bring probabilities into it to see, what is the actual effect. So let's look at, one of these curves in action and go back to some history and kind of further understand the behavior of the skew curve.
Yeah, very good, Tyler. Do you mind if we just check if there's any questions so far?
Sure, yeah, of course.
Okay, do people understand do you have any questions so far? And is that all clear? Probably would be good to ask any question you have, and I can bring the mic to you and you can ask it. Okay, I think we're good. Go ahead, Tom.
Awesome, excellent. And yeah, if anybody comes up with a question, though, I'm always we can answer some clarification questions, and at the end we'll open it up for a little wider discussion. So, like I said, let's go back in time. Let's look at how skew behaves and start to understand how does skew behave, how does it react to the markets and just movements of at-the-money volatility. So let's go back to 1987. We know in 1987, in October, the market dropped about 22% in a single day, just gap down, which is still unheard of. And prior to 1987, we had this dashed line, and it was called a Volatility Smile. Investors were weighing that, they were putting equal demand on both the put side and the call side. Investors didn't really have that much of an appetite for put options then because they had portfolio insurance. But then 1987 happened and portfolio insurance didn't really exactly pay out like they expected it to. And so now we have that shift to where they're buying puts to use for portfolio protection. So now today we have what's called this volatility skew, where once again, these puts are pumped up back here because investors are demanding protection for their long-only portfolios. And then once again, just to recap, just to remind, we have on the left side, we have our out-of-the-money puts, and the right side, we have our out-of-the-money calls. Now, you can model out in-the-money calls and in-the-money puts. You get into some strange things start to happen a little bit, but generally it's shown as out-of-the-money puts, out-of-the-money calls. And you're going to see this skew for most other indices and some stocks but this thing can shift around a little bit. Stocks can actually have a call skew where calls are in more of a demand than puts are. Let's refer back to, question one here. Why should all traders care about what skew's doing? Well, if you have a stock that all of a sudden, might shift from having a put skew to a call skew, that could be an indication that as a whole, the options market has shifted to be becoming bullish on that trade. It's maybe one explanation for why that might be happening. So the skew is really nice at showing what investors are thinking. Where is money flowing in and out of to shift this curve? Because, in 1987, what happened? You had money flowing out of the call side and then flowing into the put side. It's the shift in demand. So this is our first live skew that I want to look at. And for all of the skews that we'll be seeing today, I'm using OptionNet Explorer for that. Found it to be really good for backtesting and for looking at historical skews. For live skew data, it's all okay. For live data, you'll probably be better off graphing your own. But for historical skew data and all the examples in this, I'm going to be using OptionNet Explorer. So on the top, we have the skew curve on the Russell 2000 on October 2014. And in the bottom, we have the skew curve in November, so 1 month later. And if we think back to, some traders out there might remember what happened back in October 2014 and November. We came crashing down in October, had a V bottom, and shot back up in November. And so here I want to examine what's the relationship to, first, at-the-money volatility. What do you think this skew is going to do when at-the-money volatility decreases and goes down? Let me change to a different color. So right here, here's our at-the-money vol, and it's about 14.15. And as you go to the next month, this at-the-money vol is being pushed down to, about 12. So generally, market rises and volatility comes out. Volatility goes down. It's inverse to the market. And what's happening to the skew curve is as the market rises and this at-the-money vol gets pushed down, the skew is getting shifted. It's being pushed closer to the market, So what's happening is, in periods of high volatility, the demand for those put options is way back behind the market. And that probability curve, the probability that the market's going to come down is high. So options way back in your options chain have a lot of value in it, because investors are demanding that protection. And then as the market rises and volatility comes down, there becomes less and less of a chance of a big market move. And so, your probabilities are contracting and your skew is getting shifted in. Your demand for deep out of the money protection is becoming less and less and getting pushed closer and closer to the market. It's what we call a steepening skew, where you have a drop in at the money volatility and your demand getting closer to the market. That's what we call a steepening skew. And so, like I said, what's causing this to happen? Rising market, volatility coming out, and investors not needing to protect their portfolios way back behind the market anymore. So they're shifting their protection up. We can guess and maybe hypothesize a little bit that institutions might be buying a single dollar amount every time that they hedge. They're looking for a dollar put, and that dollar puts can be at different prices depending on where volatility is at, and that could be one explanation for this curve being shifted in. So that's
Tyler, you could just clarify the axes. Could you read? I know you already did, but on the upper graph, what is we can't really see because of the size up on the projection here. It'll be clearer in our recording, but the upper one, what is the value under the dotted line there?
Sure. Yeah. So the value under this dotted line right here is 26, and this is 24. And so what's happening at the back of this curve? Because, so now you have actually less demand right here. But when I say a steepening skew and it getting pushed closer to the market, it isn't necessarily that this value at the back is higher. It's that it's shifted in more, and the distance or the slope between this point and this point has become less. And so the opposite direction, which we'll get into next when it's flattening, is that the distance between this point and this point is greater. So it's not necessarily that the actual demand is higher. It's just that it's been pushed closer to the market. So let's look at the next example of a flattening skew. So the opposite of what a steepening skew is. So these are examples. So we're going to go from July of 2015 on this top graph to September 2015 on this bottom graph. And so we have at the money ball going from about 12, 13, and then getting a large pop up to about 20. And, this was the crash of 2015, going from 2 months prior to the actual crash itself, and showing how the skew has changed. And so what's happening in this time period? So the back of the curve is getting pushed out. Demand is being shifted out to where investors are now demanding more and more put protection far behind the market. So generally, after you have a large move, your probabilities are going to expand. So you have this large move, and now investors are saying, now we're more likely to have even larger moves. So that's going to shift the pricing to the back of the market to where now all of a sudden that those, 5-cent options are trading at, people are going to actually start wanting those more and more. And so just to recap on these two ideas, a steepening skew just means that demand is getting closer to the market. A large move is less likely to happen. As skew flattens and demand shifts far behind the market saying, a large move is more likely to happen now, and that they want more protection for their portfolios. And so to kind of wrap up this section on, how skew moves, we'll once again go back to that first question. Why should all traders care about skew? I like to view skew as kind of like the ticker tape of the options market. It shows where money's flowing into it and where money's flowing out. And different parts of the skew can be getting steeper while others are getting flatter. You can have the at the money ball actually going down, which would be indicative of a steepening skew, but way back here on the backside could actually be getting flatter. And so you can see how investors are placing their money, what that might actually line up with the market. And the more you study it, the more you get to know skew and how the options market's behaving. the more you might be able to draw some assumption and use it as a technical indicator or even a predictive measure to see where the options market thinks that the broader market might be going.
Any questions? So just so I understand, are you saying that, for instance, a steeper skew might indicate the market is anticipating a fall or crash?
Not necessarily. So you actually bring up a good point here. So skew is mean reverting. If you've seen the VIX, it spikes up, comes down, spikes up, comes down. That's a mean reverting asset. And skew is very similar. It'll have its maximums and have its minimums. If skew gets incredibly steep, where the market probability gets so tight and skew gets very, very steep, it can continue doing that for, a number of months. But if it reaches a maximum, if you wanted to be, a contrarian with your trading style, say, okay, if skew gets so steep that now you actually have a good risk reward to it, if the market breaks and goes to the downside, you could actually set up a trade on that. So it's not necessary. So skew can get steep and continue getting steeper as the market rises. But it definitely has its maximums to if you wanted to look into something like that and figuring out what's the maximum value of skew and then taking a short position in the market when it gets to that maximum. That's certainly a trade that could be researched and might be plausible. Were there any other questions?
Does anyone have any questions? Yeah, we have one. Let me just get over to where it's coming from, and that's good.
So a steeper skew, that just means that the money's closer to in the money and there's less of a chance of a big move to the downside?
Correct. Yes. Because, okay. Yes. Yeah, as skew gets steeper, demand is just getting shifted closer and closer to the market, and that probability distribution is getting tighter and tighter around the market. Correct.
Okay, then as it flattens, that means they're pricing in a bigger move, and then they're lower or they're higher on the out of the money put options.
Correct. Yeah. Okay. Actually, if you were, some traders out there might have noticed, depending on how closely you follow butterfly pricing or what the options market doing is, we actually kind of had that happen on something interesting happen on Thursday. Of last week where, butterflies are getting, or I'll stick in skew for you guys. Skew was getting very, very steep because the market was going up, volatility was dropping, especially on the Russell. And all of a sudden, the market continued going up, which usually means the skew should steepen, but it actually flattened out. And when you have kind of a divergence like that, it can create, there might be opportunities there to be exploited. It kind of leads me into my next point a little bit is, does this relationship always hold up? Does as the market go up, at the money vol drop, does skew always get steeper? Or as volatility goes down, or if volatility goes up, does skew always get flatter?
Okay, Todd, that's very good. Can we get one more question in here?
Oh yeah, sure.
Hey, Tyler, it's Luis here. Thank you. You've been talking a lot about supply and demand in defining the concept here. Maybe I'm wrong, but I'm thinking open interest. Is that something that is correlated to the skew or the direction of the skew?
No, I'm hypothesizing here, just kind of thinking that it could have an impact. So if you have a lot of trading activity at a certain point on a strike, so let's go back to the skew curve. So let me grab another different color. So let's say there's high open interest on this contract right here versus some of the other ones surrounding it. And let's say, there's a lot of buying going on with this position. This one might actually, because there's a lot of volume, the volatility might actually pop up a little bit on it versus some of the other ones around it. So it definitely can have an effect, or I would imagine that it can have an effect on individual points on this curve. If you look up here, here's a good live example. So you see the skew kind of coming up right here and then drops off right at this point versus to the next one. So there might be some, selling pressure on this strike. So definitely and market makers are going to keep this relatively in line. I would, open interest and activity on certain strikes, I would think would have a impact on how the skew is behaving. All right. So as I was saying, kind of back to the question of when volatility goes up, does skew always get flat? And when volatility goes down, does skew always get steep? So a lot of the publicly available butterfly strategies, it's generally said that, high volatility is better for these strategies, and low volatility, they can struggle in a little bit. But I want to pose the question of, is high volatility inherently always good for spread traders? Now, if you're just trading an individual option, high volatility could be good. That's more premium for you to sell versus, low volatility. It's, not quite as much premium for you to sell, if you're a seller of options premium. But because most of us out there are spread traders or trading some sort of butterfly, it's not necessarily what at the money volatility is doing. It becomes more or less is what is the skew doing? What's the difference between each of our strikes? What's happening to each individual leg of our position to cause it to make money and lose money? Because as we kind of saw, you generally know as volatility goes up, skew will get flatter, and that's generally associated with a better helping out a butterfly position. But this relationship doesn't necessarily always hold. And so by the end of this, I hope to shift the questioning from high vol, are we in a high vol or a low vol environment, versus are we in a steep skew environment or a flat skew environment? And, we're going to put some numbers behind these ideas and show, why this matters. But first, before we put numbers behind these ideas, we have to figure out a way to measure skew. How can we look at it? So everything with skew, it's all relative. If you just have a point on the curve by itself, it doesn't really mean much. If I told you this option has a volatility of 20 in it, it doesn't really tell me much. But if you start to plot out all the volatilities on the curve like we just saw, and then compare it to different expirations, we can start to see how it's moving, if it's relatively steeper or if it's relatively flatter. There's different ways to measure and look at this curve. The options chain is quite large. Have hundreds of strikes, especially on the S&P 500 or Russell 2000. And so we need to ask ourselves, what's important to your style of trading with how you set up your, either call it individual options or your spreads or your butterflies. What strikes we can ask what strikes we're using. What's our slice of the options market? And so this is the measure that I would like to show you guys today. And it's the 10-20-40 method. So what this measure is doing is it's grabbing the distance between at the money strike and the 40 delta put. The distance then goes to at the money strike to the 20 delta put, and the at the money strike to the 10 delta put. And it's taking all those differences and adding them up. So first, why these points? Why are we using a 10 delta, 20 delta, and 40 delta put to measure the distance between at and money? Well, let's think about some of these popular butterfly trading strategies out there. A 40 delta is generally where your shorts are. It can vary, but right around a 40 delta, 40 delta can be anywhere between 10 and 40 points behind the market. So about that range is where your shorts are. And then a 20 delta is about where you place your longs, depending on which strategy, what the market's doing, but it's a decent ballpark for where your longs are. And then 10 delta is generally where the risk is for some of these butterfly strategies. It's measuring what's happening where all your risk is. And so for definitions, delta is the probability that an option will expire in the money or have some sort of value at expiration. So why are we using these probability points? So by holding these probability points static, as skew gets steeper or flatter, it's going to push these points either further away from at the money or closer to the at the money. So by measuring skew this way, by taking a combination of both probabilities and volatility, we can start to learn what effect this is having on our actual prices. How is this changing the price of our butterfly? How is this changing the price of our adjustments? So that's why we're looking at the distance between the at the money 40, at the money 20, at the money 10 to see if those probability points are getting shifted further away from the money. So let's dive a little bit deeper into this measure. Let's look at where these points show up on the graph. All right, so our 10 delta is back at about 820. So right here, there's our 10 delta. Our 20 delta is, in this example, at about 860. So right here. And then 40 delta is about 900 right here. And then we have our at the money strike right here. And so we're just measuring the distance between at the money.
Tyler, I couldn't see where the cursor was there. Could you do that again, please?
Oh, sure. Yeah, so we're measuring the distance between at the money and our 40 delta, at the money 20 delta, and at the money 10 delta. And the measure that we'll look at here just a second over some historical numbers is just the grand total of all three of these. Sure. And so just remember real quick that this is just looking at the skew, and this is just skew isolated, and we don't have probabilities drawn over this. And so when probabilities expand, these are going to get pushed out. When probabilities expand, skew's going to get flatter. And then as probabilities contract and demand gets pushed closer to the market, the skew is going to get steeper and come more in this way. So let's look at this measure over the last 4 years, from 2013 to about mid-2017, about where we are right now in the market. So kind of like as we explained, so the blue line is the RVIX, or the volatility on the Russell 2000. It's a similar measure as you see like the VIX on the S&P 500. It's the same measure just on the Russell 2000. And then our red line is our skew measure that we saw. It's the 10-20-40 method. And kind of as we learned in some of those beginning slides, as volatility goes up, skew flattens. As volatility goes down, skew steepens. And you can see the general relationship between these two. It's if the red line is going up, that's flattening. If the red line's going down, that's the skew steepening. And so here I kind of want to further point out those breakdowns in this relationship. When all of a sudden, skew might be going in a different direction that you would normally expect it. And so the first time in this data set that it did this is in March of 2013. Let me change a different color. Let's do green. So right here in March of 2013, you have at the money vol, or the RVIX, staying relatively stable, but you have this huge drop in our measure, a very large steepening of the curve right here. Probability significantly contracted and demand got shifted very, very close to the market. And so it's kind of a breakdown. So, and this happens, it doesn't happen often, but it doesn't happen. And, if you dug more into this, there could be some kind of information to be learned from that, and learning, how skew's moving to how the market eventually behaves. Then once again, we have another breakdown here in December of 2015, right here. We actually have them going the opposite way. So you have the RVIX going down, which, generally as volatility goes down, skew gets steeper, but we actually had a flattening of the curve right here. Skew actually got steeper and did exact opposite of what was expected. And then once again, in September of 2016, you had quite a divergence right here. You have once again, a falling, this part right here, this down slant, you have falling volatility and a flattening skew. So generally, they move together, but every once in a while, this relationship is going to break down a little bit. And that's why it's so important to not necessarily ask, is volatility high or is volatility low? For spread traders, it's important to ask, is skew steep or is skew flat? So let's dive into this measure just a little bit more to really fully understand it. So the blue line is the same in this graph. The blue line is still the RVIX, and each one of these lines is just the broken out measure. So the red line is the distance between our at the money and 10 delta. Yellow line is the distance between at the money and 20 delta, and then green line distance between at the money 40 delta. So let's look at these time periods again and drill down what exactly is happening. So let's look back to this March time period. Volatility stays relatively flat right here, but skew significantly steepens. And so where is this happening? So it's happening on the back side of the curve. Now, why could we think that, why is the back side of the curve being shifted in more than close to the money? Why is that demand getting closer and closer to the market? Well, as those probabilities contract, the prices of those options way back there, they're becoming worthless. They're not really even going to protect someone's portfolio. So as those probabilities contract, demand's going to get closer and closer and closer to the money. And that's going to happen more generally at the back side of the curve than in the front side. And this is very reflective of investors' behavior, because you can have different moves in the front of the curve than you do in the back of the curve. And you can learn and begin to see, maybe a reflection of what investors are thinking or what their opinions are of the market. Then let's look at this December 2015 measure again. So once again, in December, you have, relatively stable or a little slightly dropping. Oops. Click forward slide. You have slightly dropping volatility, but a flattening curve, and it's happening more in the back of the market than it is in the middle of the market or even at the money. This 40 delta is relatively unchanged, but the demand in the back of the curve is significantly picking up. And this could possibly be an indicator that, investors are seeking more protection towards the back of the market. And, I think it's important to point out that, investors can be wrong. They can be buying protection and just throwing away money and not actually getting that move. Just because the back side of the curve is increasing doesn't necessarily mean that we're going to have a move down. I think this skew is useful for seeing, where's money flowing in and out of, but it's not necessarily 100% predictive. It has some reactionary parts to it as well. And then, lastly, December of 2016, we have drop in vol, and then once again, a rise in the back of the curve. You can actually see that, right here, the middle of the curve actually kind of drops out slightly on us right here. Actually, that's the next one. Here, I kind of drew over my line. So we have the backside of the curve picking up and the mid part of this curve and the front not quite as much. So very similar investor behavior as you had back in December. So I'll pause here. Are there any questions on this measure before I continue on?
Ryan?
So the RVX, that's a 30-day volatility. And your measurement, how did you get the 30-day? Or is it just something close to 30 days?
I grabbed it at 56 days to expiration, and it's just the distance for that delta number at 56 days.
Okay, so your measurement at 56 days constantly.
Correct.
Through the graph.
Correct.
Okay.
Okay, who else has a question?
Yeah, and there's no one correct way to measure skew. I grab these points because it's reflective of what a lot of these butterfly strategies trade. And so, you can, if you trade differently, you want to look at it a little differently. This is just to show an example of one possible way to look at it.
Any question?
Was there another question?
So I guess.
So what's happened is the volatility is diverging with options, which with the 10, 20, and 40, they're diverging.
Yes. Yeah, there's, investors are, their buying behavior isn't necessarily in line with traditional correlations. So generally as the market rises, volatility drops. But sometimes that breaks down to where, volatility might be increasing at different parts of the curve.
So when volatility increases, that means the market's kind of going worse, and people, though, so the market gets worse. Like in 2013, the market was worse, but people aren't pricing that in, and it's getting steeper.
Yes, in 2013, as the at the money volatility dropped, those probabilities got tighter and tighter on the market. So it was kind of the assumption the market wasn't going to have big moves, and that shifts the skew curve in tighter and tighter to the market to where that demand is closer in.
Okay.
Great. Anybody else have any questions? No more questions for now.
Okay, great. All right. So this is back to the March 2013 example. And so this curve right here is at 56 days to expiration in February. And I want to show or draw on this graph what that skew change looks like as it steepens more in the back, and those probabilities get shifted closer to the market. So probabilities are going to shift in, and so our skew curve is going to look something like this as we go from February until March from this green line, and then we'll pretend this red line is March. This is about what's happening. The skew curve is steepening. This green line is the demand back here is being shifted in towards the market. And we have a steepening of the curve. And so here, let me get rid of this. What I want to do is let's set up a butterfly on this trade. Let's look at, how this steepening of the curve is affecting a just regular 50-point butterfly. So we will put our longs back here at 850, our shorts here at 900, approximately 20 points behind the market, actually like 15 points. And then we'll put our longs up here at 950, so we have a 50-point butterfly. And our structure looks something like this. It's just, a regular butterfly. So let's look at each one of these points and see what's happening to our strikes. So we own this strike, we're short this strike, and long this strike. So this point right here, this 850 long, as time goes by, it's going to shift and start to get steeper. It's going to get a little bit of a pump up back here as the skew steepens. But does that necessarily mean a pump up in price? We have to remember when we're talking about price, we have to bring probabilities into this. And so as we learned, As skew gets steeper, the probabilities of the market get squished in. So as that probability gets squished in, it's going to have a drag on this. This is going to start losing its value, or the probability that it's going to have any value at expiration. And so although you have a pump up in volatility or for demand back here, you have that drag on price. So this point back here this long is going to stay relatively stable and not change much in price. Our short right here is kind of nice. You're taking advantage of this drop in volatility. That's great. And also, you're close to the money, so you're going to have high premium to sell, high probability value that you're able to sell. So you kind of have two things going for you right here. Have high probabilities, and you have a large drop in vol right here that you can take advantage of. And so generally, as we kind of said, as lower volatility is generally equated with a steepening skew. And the general belief is like low volatility is bad for butterfly trades. Well, why so? Why is that happening? If these two are holding up pretty well, and this middle strike right here is actually kind of liking this environment. What's happening to cause butterflies to struggle in that quote unquote grinding up market? Well, let's look at what's happening to this front leg right here. So we own this strike, this 850. And because we own it, we have this drag. It's getting dropped out in volatility. And so we have that working against us. Plus, let's think of probabilities. As skew gets steeper and steeper, the probability that this is going to have some sort of value at expiration becomes less and less. So you have that drag working on it for the same reason why you have a positive influence for those two reasons at the money strikes. You have it working against you at the front of your butterfly. So as the market gets steeper and steeper, this drag at the front of your position becomes really great. And for those more advanced traders out there, it's why you start to see a really steepening front part or a increasing gamma trend to the upside for a lot of butterfly positions as the market as volatility drops out and skew gets steeper. That's what's going on here. Is this front long up here is getting dropped out in value very quickly. So we've kind of looked at a steep skew environment can be a little challenging for a butterfly structure because of this front leg drag. But how do we determine if we're steep or flat? How do we know? So one way to do this is to look at what the skew has been on average. So for this data set from 2013 to 2017, our measure of skew has on average been at about 19%. And we can ask ourselves, are we above that measure or are we below that measure? And from there we can say, okay, is skew steep? If it's steep, it's below 19, or if it's flat, it's above 19. And kind of like we saw on the last slide, the steeper the skew is, the more challenging environment it is for a butterfly. You have that front leg crush versus a flattening environment. It's going to hold up a little bit better. So where's the trouble? Where do we need to watch out for these butterfly type positions? Where can we get ourselves into trouble a little bit? Now, I'm sure some people have been trading for a while. You've noticed like butterflies might struggle in that grinding up low vol environment. It's that problem that you have in 2013, 2016 a little bit, even some recent expirations in 2017. Just like that low vol grinding up environment. Where's the danger? Well, if you start in a flat environment, your butterfly is generally a little less expensive. It's cheaper. So if you're starting there, you can handle a good amount of range. Where you can start getting into trouble a little bit is if you start in a steep environment and you get steeper. That's when, so you already have that drag on your position on that front leg, and then it gets even steeper, so you're increasing the drag on that front leg. So let's put some numbers behind these ideas. So these are 3 popular publicly available strategies and consisting of their back-tested results from 2013 to 2017. And the numbers are the average results in these 2 different environments. The first environment above 19 and flat is pretty much saying that we started out in a flat skew and we got flatter. The second environment, we started out in a steep skew, so below 19, and we got steeper over the expiration. So strategy A actually prefers a steep and steepening environment over a flat and flattening environment. Strategy B prefers the flat and flattening environment and does not do too well in a steep and steepening environment. And then lastly, strategy C is a little bit of a combination where it can hold its own in a steep and steepening environment and then still does decently well in flattening. And before I get into, what these strategies are doing to get these results, I want to point out that they're all positive. They all have positive expectancy, which is great. That's awesome. So let's look at what's happening. So let's start with strategy B. What is this strategy doing? So this is just a straight butterfly. No adjustments or up or hedges on this trade. It's just a straight butterfly. And so as you kind of saw in that first example, that front leg is getting crushed in a steep and steepening environment versus a flat and flattening. It can hold its own. And if we think what's going on in these two environments, well, in this first environment, the flat and flattening, the market's generally going sideways to down, versus steep and steepening is generally going up. So in a butterfly behind the market's going to do pretty well when the market's going sideways to down. Strategy C is a butterfly hedged with a call, so it's managing its delta. Because it's still a butterfly, in the steep and steepening environment, that front leg is still going to get crushed. You're still having that drag of a steepening skew curve. But because you're hedged to the upside, you're not going to draw down quite as much and be able to hold your own. And then when the market's kind of sideways down, it's going to perform pretty well. And lastly, strategy A. What's it doing right here? So it's hedging both its delta and its volatility or vega position by trading verticals. And we're going to get into on this next slide and show why that's the case, why trading a vertical in a steep and steepening environment can be a beneficial trade and actually shift a butterfly to wanting to have a steep and steepening skew curve. So let's go back to our March 2013 example. So we'll draw on our skew curve again. We have our steep and steepening. And then once again, let's draw on our butterfly. So we have our longs here at 850, shorts at 900, and longs at 950. Fit regular 50-point butterfly, just like we set up last time. And we'll draw our graph over it. That line's a little crooked, but there's our butterfly. And so as we know, this back leg right here, we have the pump up and vol. But let me grab a different color. We have this pump up and vol back here. But because probabilities are shrinking in, the value is going to have a drag on it, so it's going to stay relatively stable. And then, right here at the money, we're taking advantage of this drop and plus good probability sell. And then up here, we have this drag. So like I said, the strategy that was trading the verticals to hedge both its delta and its volatility performed the best. So what is that strategy doing? Well, as the market goes up, it's taking these shorts right here at the money or at your shorts and moving them closer to the market. And so by doing that, you have two things going for you. As skew gets steeper and steeper, you're able to take advantage of a greater and greater drop in volatility. Plus, because you're moving closer to at the money, you're able to sell more probability value. You're able to have more premium to sell, plus an extra drop in volatility. So that's why that strategy that's a butterfly that hedges it with verticals can perform so much better and actually look forward to these environments. Before I go on, were there any questions about these last couple of slides?
John, were you saying you had a question? Oh, okay, could you repeat it?
Yeah, hey, we've got a question from Andrew. Where's the butterfly placed exactly in the back testing? I think he meant to imply. So on the ABC strategies.
Oh, where was it placed in back testing?
Yeah.
All of them are placed, strategy B was 20 points behind the market, and strategies A and C are 30 points behind the market.
All right. Then, not sure if you can see the next two questions in the chat box. Please ask the speaker to define his use of drag, was question one. And then the next question was you say spread, so which long are you moving with the shorts?
Okay, so drag and spread. So drag, what I mean by drag is that, so because we're long this strike out here, because we're long this strike out here, and we're having a drop in volatility or that drop in demand, the value isn't going to hold up in that option. So you're having that kind of dragging the value of that position down. Plus, as that skew steepens and probabilities get pushed closer to the market, that's also going to have a drag on it because the value is going to leave that option. It's not as likely to have value at expiration any longer. So as you get closer and closer to expiration, the value is going to get closer and closer to the market. So that's what I mean by drag, is you have those two factors working against this front long. And then by vertical, I guess, did that answer the question?
Looks like it did for the drag one. And then for the spread, they wanted to know which long are you moving with the shorts?
Sure. So these shorts right here, so what we're doing is we're going to buy back some of these shorts right here and then resell them up a little closer to the market. So you're not going to get the full difference. You get you get a little bit of an increase. So you kind of take this spread and then just move it up closer to the market. So it's a bullet. So you're trading a bullish put vertical.
Great. That was it from chat.
Awesome. All right. So
let me check if anyone else had any questions. Okay, here we go. Another question.
Just to clarify, the plus signs mean you're buying, and then the minus signs mean you're writing them off or selling?
Correct.
Okay. So then you profit. When do you profit? You profit at the ends or when it stays in that range?
It depends on which strategy you're trading. For this one in particular, you're going to profit generally within the tent. Now I'm not going to get into adjustments or anything like that. Like, these are publicly available strategies, and they have some rules around them and adjustments to show when you take your profits and when to take your losses. But generally, it's going to be within the tents is about where you're going to make your money. So as this short decays, the value is going to start becoming closer and closer to the peak up here. Versus, if the mark was out here, you're going to take this full loss. So if I draw like an expiration graph on this, your break even line would be something like that.
Okay, and then the buys on the ends, that's just to limit your risk?
Correct. Yeah, those are mostly risk control. So this center short is how you're generating your money, and then the two longs on the outside are risk controls.
So then what is exactly, can you clarify what the steepening does?
Sure, yeah.
When it shifts, what exactly is that doing?
So as it gets steeper, the demand for all these options on a curve are just getting closer and closer to the market. And as that happens, you're getting price changes and price increases and price drags on all these options that you have previously bought. So the assumption is, we bought it when we were at this green line, sold this when we were at the green line, and bought this when we were at the green line. And then as time goes by, skew shifted into this red line here. And you have these price changes that are affecting the profit and loss of your position.
And it's because it's steeper that the higher demand's worse because people aren't planning as big of a move in?
Generally, yes.
Okay, that makes sense.
Great. Thanks very much.
Sure. All right. So how do we know it's decision time? So we kind of saw, we have some different strategies that are going to perform in different environments. But how do we know at decision time, if we should be, either, buying a call or if we should be trading some verticals, and they're going to perform in different environments. And so these are two live curves laid over one another. The green curve is at 56 days and the red curve is at 28 days. And this is just one way to see changes from one expiration to the next, to see if skew is going to steepen or if skew is going to flatten out on you. Now, this will hold if current market trends stay the same, but it can, easily reverse throughout the trade. So it's not, 100%, if you have this, it's not guaranteed to steepen, but it's just one way to have a educated guess on what the market might do. And so as we can see here, we have a little bit of a volatility pop here at the money. And so if we have our butterfly over this, and we have our shorts right here, and longs at these strikes, we want to be able to take advantage of this volatility drop. So we can take our shorts and move them up to take advantage of the volatility drop right here. So that's just one way that we can show or have a guesstimate for what should be the optimal adjustment. How do we, and to see is skew going to steepen, or maybe it's going to flatten throughout the next expiration. There might be some different trades. This is just one example in one environment that's of a possible adjustment that favors a steepening skew environment. All right, so we have one last section to go over. So up to this point, we've covered how skew moves and what all types of traders can gain, what kind of value they can see from it, with the different changes in volatility or demand in the skew curve. We looked at how to measure skew, how we should view it, and which parts we should measure it based on how we trade. And then we finally looked at skew. We looked at how skew changes affect the profitability of different butterfly trading strategies. And lastly, what I want to show you guys is how do we set up a skew efficient trade? Because this example right here, it's good. It takes advantage of this environment, but how do we set up something that's optimized for skew? So let's start with the assumption that we want to set up a butterfly. So we have these two curves, and let's try setting up a butterfly on it and optimize where we place our strikes based on what we've learned up to this point. So let's start with our back long. Where would be a good spot to place our long? We could look back here all the way at the back of the curve. Let's think about it. So if we're going to be buying at this purple line is 84 is where we're at, and the assumption is we're going to morph into the blue line at 56 days. And so, we have a pump up involved back here, so that's good. That'll hold up the value a little bit. But because we're so far back on this curve and the probabilities are going to shrink in as skew steepens, you're going to have that value leaving the position. So this back long won't necessarily hold up as much as you might think it will. So let's try to find a nice balance between both volatility and probabilities. And so a good balance is right here at 1250. So you don't have any sort of change in volatility. from one expiration to the next, so that's going to hold constant. And you're relatively close to the market right here, to where as probabilities contract and you have that drag on your price, it's not going to have a drastic effect so much as you would if you got something way back here on this curve. Next, let's go into our shorts. Now, where's the most optimal to place our shorts? Well, it happens to look like it's right at the money, because that's where your biggest vol drop is. From this purple point down to the blue, that's where your biggest vol drop is. Plus, remember, at the money, we're going to have our greatest probability value. That has the greatest probability of expiring in the money without actually being in the money. So that's where we're going to place our shorts, is right there it's the 1370 strike. And then lastly, we have our final long. Where should we place our final long? And, we could place it all the way out here on this curve to maximize or minimize the drop in volatility we're going to have out there. But for the same reason why we didn't buy our long on the other side skew way back here, because once again, as skew gets steeper, our probability is going to get closer to the market, and the value is going to drop out relatively fast on us out there. So we want something that's going to hold up a little bit better. So once again, let's find a balance between probabilities and volatility. A good balance is about 1480 right here. So we're going to buy this strike. And, we have a little bit of a drop right here. So we're going to have a little bit of a drag, plus, probabilities working against us. But it's going to be the best strike selection for the options we have available. So we're going to get long right here. All right. So now that we have it set, a volatility optimized butterfly setup to take advantage of a steepening skew, let's see what that looks like on a risk graph. So before I go any further with this, I want to emphasize that this is only a trade. This is not meant to be a strategy. It's not. I'm not going to go over risk controls or adjustments, anything like that. It's just meant to be a demonstration of the power behind skew.
Tyler,
yeah.
Could you hang on one sec? Just before we forget the previous slide, Ryan had a question.
On that last slide,
Sure.
Is there, can you just say, from the graph, can you tell exactly why that's a good place to place your, I'm sorry, let me rephrase that. You said that due to probability, but this graph doesn't show you anything as far as probability. Are you saying from experience, that a certain delta is going to be a good probability, and that's why you place your longs?
Yeah, there's definitely a lot of research that can be put into overlaying a probability curve on top of this graph. But it's more or less just from experience, knowing what probabilities are going to hold up, and just from some back testing and research to knowing about what the best point is. And I'm not saying that these points are optimized, and there could be some different shifts to be made in them, and overlaying an actual probability curve on top of this and be incredibly helpful. But it's mostly just from both back testing and from experience.
Do you have some deltas you could throw out that we might be able to use as a guideline? Just rough deltas?
That might have to be some back testing that needs to be done. But that's an excellent idea.
Excellent. Thank you.
Sure.
Good.
All right, so here's our risk graph. And once again, it's just a demonstration. And so first thing I want to note is our gamma trend, or our T+0 line. And it looks like, we have risk to both sides of this market. But our modeling software doesn't know how to predict changes in skew. It's grabbing what the skew is right here. So how we're going to make our money isn't actually being reflected by this risk graph right here. So let's look at our numbers. So we have, slightly negative delta. It's not going to last for long. Our theta is about 2,000. So it's projecting us to make about $2,000 every single day that the position goes by. And then our Vega position is 20,000. So for every negative 20,000. So for every point drop in volatility, we should be making $20,000. But I've kind of cherry picked this expiration for a reason, is that at the end of it, at the money, volatility is unchanged. So that Vega number isn't going to have an effect on this position. The market is going to be relatively unchanged. I think it's down about 2 points. So delta isn't going to have much of an effect on this position. So the only thing besides that could be having effects is...
Tyler, could we just zoomed in on the area of the page that shows the Greeks, and it's not going to be too visible here in the room, but Vega's the bottom one.
Correct.
And what were you saying about Vega, for instance?
So for Vega, since I've kind of cherry-picked this expiration, so for every point drop in volatility, this position should make $20,000. But throughout this expiration, volatility is going to be completely flat and unchanged. So that's not going to have much of an effect on this. I've chosen this expiration to isolate skew to show what the power is behind the steepening of that skew curve when you put it in your favor.
Okay, go ahead.
Sure. And then, so the last number on here is our theta number, about 2,000. So every day that goes by, we should make about $2,000. So let's click forward a few days and see what happens. So 10 days go by, and the trade is practically unchanged. Nothing has really happened. Apparently we should have been getting, $20,000 in theta in this trade, but that didn't come in. Now once again, this trade is focused on skew, and up to this point, skew hasn't really changed in this position. So let's see what happens when skew finally does steepen and it goes in our favor. So in 5 days, we go from being flat to up $76,000 or 16% over a 5-day period. And over that period, theta was only supposed to add about $10,000 to this trade. And so even then, we're up $66,000 of just skew because volatility and market movement has been isolated. And that's the real power of setting up a structure when you optimize it to a skew curve and picking out those strikes, is that you can make quite a bit of money by setting up these types of trades and putting skew in your favor. Let's click forward to the end of this trade and see what it looks like. So like I said, at the end of this trade, there's been no change in at-the-money volatility. So our Vega number has no effect on this trade. The market was relatively unchanged, so we haven't really profited from delta. And our theta projects, we should have made about $50,000 from theta. But at the end of it, at 25 days, we've made $111,000 or 23%, with about half of that gain theoretically coming from skew. And that's the real power behind this, is it's another edge to be looked at in the marketplace. It opens up other doors for different possibilities of how to set up trades and to specifically trade the actual skew and the changes of it. Now, I've just shown one example of what happens when it steepens, and you very well could set up a trade for if it flattens, stays still, different parts of it shift. There's a lot of edges to be gained and to be looked at by examining skew, learning it, and finding out how to better predict and place strikes on the market. So let's go back over what all we've learned. So first, why should all traders care about skew? It can be used as a way to gauge investors' opinions on where they think the market might go and where they're putting their risk, whether they're buying extra put protection, maybe they're selling calls really heavily, maybe they're actually buying some calls. It can be used as a way to gauge investor sentiment. Second, we learned how we should measure skew. To see the full impact on how it affects your trading, you have to combine both the use of, or a good idea would be to combine the use of both probabilities, and volatility, and to also focus on what your section of the options market is. The options market can be quite large, and I've only looked at just skew on a single expiration for the most part here. And the market's quite large, so you need to focus on what's going to be affecting your trades. Then we looked at the effect on butterfly returns and saw that low volatility generally equates with steepening skew. You can also sometimes have a flattening skew in low volatility. So my hope is that most butterfly traders or spread traders, if you're just trading a single option, high volatility is generally good because you have more to sell. But if you're trading spreads, it becomes more important of what the difference in volatility and how those points that you've bought and sold are changing relative to each other. So it doesn't necessarily become, is volatility high or is volatility low? The question should be, is skew steep or is skew flat? And lastly, we looked at how to trade skew. What are some ideas to get you guys started on looking into your own strategies, or how to adapt certain ideas and apply it to your own trading. So with that, thank you everyone for sitting through that. I hope that everyone has learned something from that they can apply to their trading, whether they're trading options or a different product. I'd also like to give a quick thanks to everyone at Raleigh Durham for setting this up. Thank you, Don. Thank you both Ryan and Wayne. Those are Ryan is owner of Blackpier, Wayne's head of research. They helped me out tremendously with preparing for the presentation and helping with some of the research. So thank you guys. And with that, I'd like to open it up for questions.
Okay, so Ryan has something.
Have you guys found any value in studying moneyness in relation to volatility?
Sure. Yeah, that was actually what I first started out on when I was first looking at skew. As I was using a Bloomberg terminal at the time, so that's what led me to it. But yeah, it's just a different way of looking at skew. There's not necessarily one way is better than the other. It's just different ways to look at it and what's most important to the way you trade. I think that's the most important thing to focus on, is because there's so many different measures. I focused on just the put side. You can look at puts to the calls. You can look far behind the market. You can look at just the call side and what the bottom of that curve's doing. There's almost infinite ways to look at it, infinite ways to measure it. So just the most important question is just, how does it affect your trading?
Very good. Who else? I guess, what are how much information on this is available in terms of books or papers? I know that there's a major book that came out this year on skew, I think, Volatility Smile by what are some references, either that or anything else that you would recommend, or are there any, or is this all your own proprietary research?
Sure. There are some good resources out there. VixCentral.com, that's a pretty good resource for contango, so looking at the term structure of volatility. That's a good one. As far as books goes, one that's had a good impact on me was Trading Volatility by Colin Bennett. I think you can find the PDF online. But as far as, this is one reason why I was looking forward to giving this presentation, is that for the longest time since I've been researching it, there's a lot of information out there on how skew moves, how it behaves, but the actual application of it and how to set trades up in an efficient manner, there wasn't too much information out there. So that's some research that I hope that people are going to gain from the last section in this talk of how to set up skew efficient trades. But as far as resources outside, it's you might have to dig a little bit for it. When I was first starting out, I was reading academic papers on it because that was about the only thing available at the time. There's gotten to be a little bit better information, but it's definitely an area that still needs to have light on, especially in the application arena.
What academic paper author would you recommend?
Honestly, I'm not too sure of some of those papers and the authors.
Yeah. Okay, Mark?
Yeah, I just wanted to ask, so in most of the examples you were modeling out a symmetrical butterfly, and I'm just wondering, are there any considerations trading a broken wing structure, either broken wing condors or broken wing butterflies? I mean, I guess it's just where your short strikes would fall on the curve, but could you make any comments about that?
Sure. Yeah. And, we looked at the examples of, what it looked like when you traded a vertical and moved your short strike a little closer to the market to take advantage of more of that volatility drop. And so, one thing you can do is you can look at where your strikes fall when you're setting up your trade on a skew curve and ask yourself what strikes are being held up and in my favor and what strikes are being dragged down. And, there's different ways to look at it too. So, you can always instead of moving your front short forward, you can bring your top long back and move it closer to the market to minimize your volatility drop. I just showed one adjustment today with that single vertical. And there's different ways to adjust it to minimize the drag that you can get with, certain broken wing butterfly positions, butterflies or condors.
Could you go back to the slide with the different skews and where you set your trade up originally?
Sure. This one?
Sure, that'll work. Now, imagine that we were in a reverse situation where skew, instead of falling, was going to rise.
Mm-hmm.
How would you set up your trade in that situation?
So if it was going to make the opposite direction, I would honestly just set up the exact opposite. So where I had my longs, I would just place my shorts. And because this trade is going to be so heavily focused on the change in skew, and that's what's going to ultimately drive your profitability, because, as we kind of saw in some of these, we didn't really get any theta change, and theta isn't actually in the position of the modeling software has a hard time or really can't predict changes in the skew. And so when you're setting them up, some of these positions can look kind of ugly when you're first setting them up. And, it appears that you have a lot more risk. But because it doesn't model skew, you have to, if you click forward in days, you'll just, all of a sudden, you'll see just money really quickly coming into the position. Kind of like what we did right here, in 5 days, you have, 16% coming in. But so if we're setting this up, it'd just be the opposite position of this. So you just flip it on its head. And so we'd be able to take advantage of a flattening skew environment. It's just when you're setting up these trades. And so, one of the things with this one that you could also do is we have to consider probabilities. We had theta coming by in this trade. So the assumption is, half the position gained because of theta. So we'd be, if the opposite position happened, we'd be having that drag a little bit of theta. Be having, if we flip it upside down, it'd be sinking down into that hole. And so one thing we could consider here is bringing probabilities into it. And to make it the trade even tighter on the market to where the value of those longs are going to hold up a little bit better so that the drag of theta isn't going to be so much on the trade.
Tyler, I got another question here. This screen we're looking at, I'm assuming that this is hypothetically, the date is March 17th. So how do we know what the skew curve is going to look like in the future? We're looking at, a point in time. If just one of these graphs was on the screen, I wouldn't know whether it was going to be flattening or steepening over the next month. And so that's kind of a piece of the puzzle you need to structure your trade, as far as I can tell. So what do you think?
Yeah, of course. And that's why you need to compare one skew curve to the next, because, a curve by itself is, you can learn a little bit from it, but all of this is relative. Everything I've covered today, it all has to be relative to something else, because 100%, if this purple line was just by itself, we have, no way of knowing. And, at this time, so this is December 2013, 2017 in this example. And so the 84 DTE is the 84 DTE expiration, and 56 is 56 days expiration. So this information at the time of the trade, where you just overlay one expiration to the next expiration. And the assumption is that the skew curve is going to morph into the next one, into the next expiration. So 84 is going to start to look more and more like 56 as you get closer and closer to expiration. Now, doesn't always work that way. Skew can flatten on you if you have a spike in volatility. So it's not always going to hold, but it's a start, somewhere to start looking at, to saying, okay, if the market trends continue, this is what the skew curve is most likely to do.
Tyler, are you actually trading live yet, or are you still in preparation in your fund?
We've been trading live for proprietary. We've been trading live for about the last 5 years, and the fund has been open to outside investors for the last 3 years.
Wow. So you must have, what are some of the lessons or insights that you've learned, or one or two of them, as to just trading butterflies? In other words, people here are going to try and look at some of this stuff and incorporate it. And meanwhile, as they nibble at the very beginnings of that, they're stuck with trading, for now, the butterflies strategies pretty well as they come, as they're laid out. And, we have M3, we have others too, Road Trip, 60-40-20. Are there any insights you've gained as to just how to approach trading those strictly by the rules? Or, one insight is obviously going to be taking into account skew, but are there any other insights?
Sure. So I think one of the most important things is, first off, one, following the rules of the trade. So if you're given a set, just following the rules and you'll do just fine. And then second is not trying to make a trade something it's not. So like for the example I showed, with doing that vertical, you can only do so much to that trade to make it do okay in a steepening skew environment. What I think is a better solution is to pair multiple strategies in a single portfolio and position size accordingly. So it's kind of the whole idea of just diversifying yourself. So maybe you'll have something that's going to do good in high vol, or something that's going to do good in low vol, something that's going to do sideways, maybe something that's opportunistic, or something that does good in a steepening skew environment. And it's taking these different trades and combining them in a portfolio. As if we think back to modern portfolio theory, the idea is that we combine strategies that have maybe higher volatilities with them, but if we put them together in a portfolio and allocate them accordingly to their volatilities, we can reduce our overall portfolio risk, but increase the return. And so by doing that, I think it's not necessarily, that one strategy is particularly better than another strategy. It's how you combine the available strategies out there and pair one strategy's weakness with another strategy's strength.
That's
to give you a more...
Yeah, that's definitely a key insight. I appreciate that, Brian.
if you are net short volatility, what kind of trades do you do to hedge against a discrete black swan event?
Sure. Without getting into too much proprietary info, I would, it's the black swan events are a little challenging because you're protecting against something that, doesn't necessarily happen all the time. And one thing to consider when doing this is that expense dragging down on your portfolio to where if you took, let's say, you're spending $500 a month to protect your portfolio from black swan hedge. If you took, or from black swan event, if you took that $500 and then put it back into your actual trading, would you still net out more money at the end of your trading period? Call it 10 years if you had a black swan event. Would you be better off not protecting your portfolio versus hedging? Now, I think you should. For me, I like to hedge, and there's ways to figure out to where it's not a drag on your portfolio. And kind of going back to pairing different strategies together is creating a strategy that has a black swan hedge that has a positive expectancy. So over a 10-year period, can you design a hedge that will protect your at-the-money strategies, but at the end of that 10 years actually make money and not be costing you anything? So there's definitely ways to do it and ways to hedge. And there's I think there's some really good information out there. I know you guys had Ron Martino come and talk with you guys or to the Raleigh-Durham group a couple times ago. I've looked at his stuff before, and I think he has a pretty good program and some good information out there that could offer some solutions to that.
He does, and Brian, who's we're talking to here, has written his own book on it too, Brian Johnson, which is also excellent, and he's spoken also.
Okay, I appreciate the response. Thanks for the help.
Sure.
Anything else? Any other questions? I guess we're pretty well out of time.
Sure.
But if anyone has any final point, they would like. Are there any, John, on the side? No, I think, I thought that was absolutely outstanding talk. And, I think it's one of the ones where people need to go back and look at the recording if we can get one. But you're going to give us a copy of the slides also. Is that correct?
Sure. Of course, yeah, I can send it. And I'll type out my email. I realized I didn't put it on here. So if anyone has any outstanding events or outstanding questions, you can email me at tmichalove@blackpiercapital.com. And then I actually think I forgot to mention at the beginning is, Blackpier, we do accept managed accounts as well. So it's not all just millionaires, but yeah, we accept the managed accounts as well. If you guys have questions, anything, then we're always looking to help people out any way possible. If you guys have extra questions, you can email me at tmichalove, Blackpier Capital, or for just more general info, you can email info@Blackpier Capital as well.
Absolutely fantastic. A lot of work went into it. We really appreciate it. Let's have a nice hand. Thank you so much. We'll say good night.
Sure. Thanks. Good night, guys. Thanks for having me.